Welcome to another episode of A Quest for Twice. Today is May the 1st. ILMN reported the first quarter earning. So let's dive into the numbers. As shown in the chart on the bottom right, we can see its revenue peaked in the first quarter 2022. Then just sequentially declined to the latest quarter. What's also alarming on the surface is the gross margin that peaked in the second quarter of 2021, then just keep on going down and reached a low point in the first quarter of this year. So what are the reasons of the margin and the revenue declines? There are two key reasons. The first one is ILMN benefited from COVID-19 testing. So now with the pandemic largely behind us, there are fewer COVID tests and less demand for ILMN products. On top of that, ILMN is rolling out and shipping a new generation high-throughput test equipment called NovaSec X. The previous high-throughput generation is called NovaSec 6000. That was launched in 2017. So if we look at the margin and the revenue chart on the top right, we can see that in 2017, there was also a dip in revenue compared to 2016 and 2018, as well as a dip in gross margin. And that was temporary. So as long as NovaSec X is selling well, I expect the revenue and the margin to recover. The management also mentioned the negative impacts from China reopening after the COVID, as well as sanctions on Russia due to its invasion of Ukraine. The management also announced about $100 million run rate cost reduction initiative that will boost operating margin by about 2 percentage points on an annual ongoing basis. So I am not really alarmed by the temporary decline in revenue and margin. The more important question is can the growth continue, and how is the rollout of NovaSec X? So the rollout is actually going really well. Now there are over 200 orders the company has received and expect to ship over 330 equipment in this year. So both the orders and the shipment estimates were revised up compared to the guidance given about 3 months ago. On the valuation and the risks, I don't have any significant update except to report that the management mentioned there were 2 appeals related to Grill spin-off from ILMN. Both appeals should bottom out in this year. If either one fails, then Grill will be divested from ILMN. Alphabet, aka Google, also reported the first quarter earning. So there are some bad news and some good news. Bad news includes decelerating cloud segment revenue. So in the latest quarter, the year-on-year growth was 28%. It's not a slowdown from 32% and 38% in the previous 2 quarters, and significantly less than the CAGR of 38% averaged over the last 6 years. Another bad news is on the services segment, which includes mostly the advertisement revenue. That segment has a stagnant revenue growth. So if we look at the chart on the bottom left, we can see actually it's the second quarter that has almost no revenue growth for the services segment. So what is the good news? The good news is that the services segment improved its operation margin. In the first quarter, the margin was about 35%. That was a significant bounce back from about 32% in the previous 2 quarters, and almost reaching the margin from the first quarter last year and the second quarter of last year. The margin improvement was because of the payroll and the real estate expense reduction, and also helped by reduced depreciation cost. So the company is tightening its belt because of stagnant business from the services and advertisement. On the valuation side, the EV over ops income is still relatively cheap compared to its range in the last 10 years. Of course, it's not as inexpensive as end of 2022 because of the rebound in this year. Another added threat is the ChatGPT may steal market share and advertisement dollars in the long run. Of course, Google is working on its own generative AI product, so the outcome is hard to predict at this point. But I just want to list this threat for future review. Now let's look at the Meta platforms, aka Facebook. Its stock price declined 65% in last year, but is up 91% year to date. So in February last year, the stock price plummeted because of the fourth earning 2021 results came out. Investors realized it's no longer a growth company. After that, with each earning release in last year, the stock price was further punished. So fourth quarter 2022, the sales were down 4% and up 2% on constant currency basis, versus first quarter this year, the sales were up 3% and 6% on constant currency basis versus a guidance of a decline of 4%. For the second quarter, the management gave a guidance of up 7.5%. So not a whole lot of sales changes. Down 4%, up 7% for a big company. That's not a whole lot, but the stock price movement were very dramatic last year and this year. It's partially explained by the operation margin change. So in the latest quarter, the ops margin was 25%, a decline from 31% 1 year ago. That's because of a $1.1 billion of restructuring charge, resulted 4% margin hit. By the way, there was a 13% margin impact in Q4 last year. So if we add 4% back, the ops margin was almost the same as 1 year ago. The first quarter R&D expense rose 22%. That was impacted by the charges, so it's not that meaningful. But it is meaningful to note the operation loss from metaverse investment of $4 billion, compared to about $4 billion in the last 2 quarters. In terms of user monetization, it's Facebook daily active users grew slightly, mostly driven by growth in Asia Pacific as well as rest of the world. Same story with the family daily active people. That metric saw a slight increase. The ad impression was up 26%, but with the lower ad price by 17% compared to 1 year ago. Probably more interesting is to look at the Facebook average revenue per user. So in the Q1 this year, That was $9.62 comparing to $9.5 1 year ago. So that's a slight increase. But if we look at the US and Canada, the increase was a minimum from 48.3 to 48.85. Same story with the European users and Asia Pacific. However, if we look at the rest of the world, the revenue per user did have a significant increase in the range about 6 to 7%. So for US and Europe, just rising slightly versus a decline last year was good news. Because that means the headwind from new iOS privacy policy is dissipating. And the short video product Reels is competing well with TikTok for advertisement money. So I would say its advertisement business is stabilizing. Now let's look at the valuations. So at $240 per share, its EV over gross income is about 6. That's still relatively cheap compared to the last 10 years, with the exception of 2022. EV over EBIT is about 16.5, and the cash flow yield is about 8%, despite the investment in R&D and the metaverse. So I would argue the current price is reasonable for a stable business. Maybe there is even slight revenue growth built into the price. So if the metaverse investment is a complete bust, then there is very little upside from current price. So I believe I made the right calls in the last year to highlight the attractiveness of a metaverse stock. However, I didn't really banked on that correct calls because I made a wrong decision at the end of last year to sell my Meta stocks to harvest loss for tax reasons. That cost me about 1.5 percentage points in this year from my total portfolio performance. So that will definitely go into my end of the year lessons, which I will elaborate in December. The last company I'm going to cover today is Amazon.com. So in the first quarter, its overall sales grew 9% year on year, roughly in line with the prior 4 quarters, because in the third quarter last year, it benefited about 400 basis points from Prime Day timing. So for the second quarter of this year, the management gave a guidance about 5 to 10% growth outlook. Now let's look at the chart on the bottom of this slide. So we can see almost all its segments have stabilized. For its online store segment, there is virtually zero growth. However, for most of our other segments, they saw steady and stable growth, with the only exception is AWS. AWS had a 16% growth in first quarter, comparing to 20, 27, 33, and 37% growth in the prior 4 quarters. So a clear trend of decelerating growth. Again, this is good news versus bad news situation. AWS is bad news. So let's look at the costs and the AWS in a bit depth. Look at the chart on the top right. The cost of goods had a further decline. Now it's less than 54%, comparing to a peak about 63% at the end of 2020. So management is making pretty good progress to reduce its cost, because COGS is the largest cost component for Amazon. So the improvement is really important and impressive. This is despite a slight uptick in fulfillment costs, increased to about 16.5% of total revenue. And that's roughly in line with the previous 4-5 quarters. As a result, the whole company's ops margin was 3.7% compared to 3.1% 1 year ago, and 3% margin in the first half of 2022. And that's after suffering about 0.4% in charges from restructuring and impairment. So ops margin is doing well due to the cost improvement I mentioned. Its technology and marketing cost went up by 38%, but it was absorbed by the lower costs and as well as revenue growth. The true bad story is AWS. Its ops margin is about 24% versus a norm of 30%. And also, as I mentioned on the previous slide, its revenue growth has been decelerating. So that growth was about 40% about 1 year ago. Then afterwards, it just started this downward trend, reached 16% in Q1 this year. And the management gave a rough guidance about 11% growth year on year for the second quarter of this year. The reason of the deceleration is because Amazon is working with its customers to reduce cost related to IT spending, because cloud computing is highly scalable. So when the customers don't want to use that much capacity, they give it back to Amazon, and Amazon suffer the consequence. To me, it's not a big deal, because it's not a fundamental issue. It reflects the current downturn in the technology sector, as well as the general economy uncertainties. So Amazon is providing excellent customer service to help its customers to reduce cost. I believe this will help itself in the long run to have loyal customers and to grow its revenue and accelerating again once the current economic downturn passes. Its EV over gross income is about 5.1 at $105 per share. That's lowest in trailing 10 years, except at the end of last year. So I think its current stock price is still attractive. As I mentioned in my last episode, I think the general market is currently too frothy. So I plan to wait until the market turns pessimistic again, then may add to my position in Amazon. So this concludes the latest episode of Quest for Twice. Until next time, happy investing.